All right, and the consensus in markets today is that Beijing would reach a deal with the US and avoid worsening trade hostilities. As a result, the risk premiums for China proxies such as the Aussie dollar have been erased. However, it's too early to price out the US-China trade war. ING markets analysts say the real worry is that the markets have jumped a little too far to the positive, as Trump is probably not in a rush to end tariffs on China as he did with Canada and Mexico. Since Monday, when Trump delayed tariffs on Canada and Mexico after a border agreement, the dollar has maintained its downward trend. The spotlight has shifted to China and the markets are holding out on hope that a deal is likely to be reached before Beijing's retaliatory tariffs take effect on the 10th of January. Beijing's comparatively restrained reaction to Trump's tariffs is keeping markets buoyed. ING analysts believe markets are underestimating the possibility of a protracted trade war, even if the likely scenario for a US-China agreement, the US consumer and production base is less affected by tariffs on China compared to Canada and Mexico, giving Trump more leeway to negotiate a deal at his own pace. Now, Trump has clearly indicated that he is in no rush to speak to Chinese President Xi Jinping. The story of protectionism is still the major focus for the time being, even as US macro news is making a comeback. While December's US payrolls were solid, the latest JOLTS job opening data this week were less encouraging for the jobs market. Investors will eye the non-farm payroll data late on Friday for macro directions on the economy. The Federal Reserve has announced an extended pause in the current rate cut cycle. US central bank officials are concerned about inflationary troubles from the trade tariff strategy and are warning of a fine balancing act again if payroll figures show any weakness. For latest news, download the WION app and subscribe to our YouTube channel.